fact, one of the major features, it seems to me, of regulation, of financial regulation, since it was conceived in the 17th century in England, has been that it is scandal-driven regulation. It has happened with the regulation of the city back in the 1700s. It has happened more recently in sophisticated markets in the United States, following, for example, the Enron and the dot-com scandals. We've had the Sarbanes-Oxley Act. So this is very much regulation of closing the stables after the horses have gone. And I think maybe this is an opportunity to take stock a bit, to not to judge the success of the regulator by the weight of the statute book, if I can put it this way, but rather by the quality. And I think on this, we are not perhaps doing as well as we ought to be doing.
Thank you. While you're thinking of your contributions or questions, I'll just add a footnote to say that as a judge, both in the Court of Appeal and in my present position, I've come across a few cases involving recent financial crisis. And one thing that has struck me is the extraordinary complexity of the documentation involved in these cases. In one case involving derivatives, the basic documentation of the deal was well over 500 pages and extraordinarily complex. And I'm quite satisfied that there wouldn't have been a single senior executive at the bank involved who would have understood this documentation. And I think it's the essence of good governance that the top executives, we saw this, of course, in the actual life crisis as well, that the board simply these days very often does not understand the basic transactions into which their institutions are getting. Any questions from the floor? If you identify yourself, please, however well known you are.
Yeah, I'll ask another question. Trevor Dadson, Vice Principal, Humanities and Social Sciences at Queen Mary. We were told, or we have been told all the way through this crisis, that governments had no choice but to bail out the banks with vast amounts of public money. And yet the markets work on the basis, I'd always assumed, that everything is risk. If you get the risk right, you make lots of money and you survive. If you judge the risk badly, you lose money and you don't survive, and that's the way the markets work. It now seems that we're moving into a new position where if you judge it badly, the state will bail you out. So the sort of the brake on, in a sense, on risk, which is actually letting the markets operate, has gone. We had an earlier panel where one of the speakers from the Department of Energy and Climate Change, I thought, made extremely interesting points. They know what we have to do to avoid climate change, to get the carbon footprint down and protect the planet. But he kept saying, but we haven't got the money, we haven't got the resources. And they know what they have to do to meet their targets. I would have thought probably everybody in this room would agree that climate change is far more dangerous to us than the collapse of the banking system, and that some grotesquely overpaid bankers go bankrupt is not something that should make any of us lose sleep. So have we got a real problem of our own making now, that banks and other businesses will have no break on their taking risk because they know that the colossal amounts of monies that they lose, we will pay for.
I think it might have been a question. If I can just make one small comment, it's really it's the same old story of if you owe the bank £10, it's your problem. If you owe the bank 10 million, it's their problem. It's the same in relation to banks and governments.
John Davis, Mylan Group. It's a follow-up question. I mean, one of the issues, Trevor, was that the governor of the Bank of England, Mervyn King, wanted to see Northern Rock collapse. He wanted to see it go. This moral hazard argument, it was just the links. You're talking about the documentation of the derivatives market. It seems to me that we had a warning 15 years ago with Bearings? Exactly this argument, wasn't it? When Nick Leeson was doing things that his directors had no idea about. I mean, I don't know how you disentangle all of these things, but you saw the Americans, they let Lehman's go. We very nearly collapsed. The Western, the Western financial system nearly collapsed. Who knows the answer to these things? But they clearly are too big to fail.
My reaction to these two comments is that I don't think that the reaction by government was a regulatory reaction. It was the way it was served when it was served. It was that effectively in the banking system we have two basic categories: the retail banking and the investment banking. And the feeling was that the retail banking support was justified because ultimately it affected small and medium-sized enterprises. It seems to me, however, the way it has worked, at least in the last 12 months, is that most of the money went to the investment banking to support effectively the capital market structure on the premise that the capital markets do have a significant role in the economy, in both sides of the Atlantic. Now, in the US, the banking system, as sophisticated as it is very different from what we have, because they're not comprehensive banks that do everything. So they either do retail or do investment or they're building societies. So it seems that the UK system of the reform of the financial institutions actually amplified the crisis to what it is, and I think it's better to stay here to not make a further political statement.
Well, I think the question the Vice Principal put, I think, is obviously at the heart of the problem, and I'm not sure if there is a single answer. It seems to me that banking is not really a sector of the economy. It seems to me that it is a transversal activity. It affects the whole of the economy. So in that sense, when things go wrong in a big scale, the way they did, it affects the public interest. It is a service of general economic interest. So in that sense, I don't think it was, I don't think the governments got it wrong by intervening. One reaches a stage where the costs of non-intervention exceed the benefits, and I think this is pretty much what we reached. I don't think it was the mistake only perhaps of I don't think it was only an issue of moral hazard. I think it was in some ways also the result of a very liberal monetary policy, which in the event proved unsustainable. Now, where does one draw the balance? Obviously, it is a very difficult question to answer in the abstract. But I have found that perhaps in the US, the government finds it more difficult to act against the interests of the industry, of the banking industry, than perhaps what is the case in Europe. I think that is an interesting distinction. So in that sense, the symbiosis, the coexistence between the interaction between the banking industry, the financial services industry in the US and the government is different. The government is more captured there by the interests. But I don't think it's the end of capitalism. I think we are going to survive this.